Okay, we are seeing some weakness in North American trading this morning. The TSX in particular is quickly down more than 200 points. A lot of that has to do with the market reaction to Shopify, not the only technology earnings story we're watching today, but it is a reminder that a lot of the tech stocks have been flying high. Our next guest is still pretty constructive on tech. Let's get some perspective on the road ahead for investors. Brenda O'Connor Juanas joining us, Senior Vice President and Financial Advisor at UBS. Brenda, it's nice to have you back with us. There's been so much to digest recently between thoughts on interest rates and, of course, earnings season. How have you felt about what's been happening in the markets of late?
Well, John, let me just zoom out for 1 second and let's just take inventory about what happened. In March, we did see a little bit of a market movement based on these higher than expected inflation rates. And what did we really see? We saw rates reprice. We saw the 10-year go to 4.7. We saw a pullback in the S&P, and we saw all these hopes for June cuts essentially taken away from us. John, in the last week, we've seen a little bit of a shift in the narrative, partially due to Powell's more dovish talk, but more importantly, I think because of that soft payrolls number that we saw last week, in addition to some other employment data that really is evidence of this disinflation. So, where I stand now is I still think markets can grind higher, and we're still pricing in 2 rate cuts really starting in September.
And so, given that, how are you approaching sectors? What do you think are the areas that are best positioned to outperform if that plays out as planned?
Right. And, your previous guest just talked about tech. So let me continue that thread. We still like tech based on the notion that these companies have strong balance sheets, strong earnings growth. And look, I know these stocks are expensive. I have clients tell me all the time. They're not buying something with P's over 30 or higher. But John, the point is that these earnings numbers are telling a story that justifies the valuation. So as an example, Amazon, Alphabet, and Meta alone delivered, $60 billion in profits in the first quarter. We still think that these high quality tech names will be able to deliver 20% earnings growth. The other stat that I really loved out of that Q1 earnings season was that these 3 companies alone were spending over $140 billion in AI CapEx. And so that just tells me that investors cannot afford to have no exposure to AI or to these quality tech talks. I think there's a way to kind of barbell it where you're getting exposure to these big listed names, but also on the other side, if possible, invest in some of these smaller private names that have a real attractive trajectory of growth.
Now, it's a fascinating group. You can look at it as growth. You can look at it as defense. Maybe at the end of the day, it's less of a story around interest rates, but you talked about rates, and there are rate-sensitive sectors. Utilities, I think, is a good example that have had a notable move higher, call it over the last month. How do you feel about the outlook for a sector like that one?
Yeah, utilities is not one of our preferred sectors. We group that in a basket where we're probably staying away from. If you're looking at sectors still, I would prefer healthcare, again, tech, but industrials, John, is another sector that looks interesting. Again, we think industrials will be the beneficiary of the stable GDP that we're seeing and the reindustrialization of the U.S. economy. Within industrials, look, it's a big sector. There are lots of different facets of it. I think defense names could look attractive. And look, we are in this really prolonged, frankly, dangerous geopolitical backdrop, and some of these defense names have proven that they're going to do well. We saw that in the Q1 earnings. So I think that those 3 sectors are ones that I would focus on and maybe stay away from things like real estate and utilities that are incredibly rate sensitive, as you mentioned.
Meanwhile, Brenda, we were showing our audience some of your investing ideas, and you like gold. Gold is very interesting. Obviously, it was on this record run as people started to reassess what happens with rates. We did see a pullback recently. I think that oftentimes you think, oh, gold is this inflation hedge, but actually the growing expectation for rate cuts was one of the drivers, call it from the lows of last year into the highs of this year. And you were just telling us, you still think there are rate cuts on the table. So is that a consideration in your view on gold potentially moving higher from here?
Well, John, I've been talking about gold for the past 6 months like a broken record. I was buying it under 2,000. We're at elevated levels here. Our view on gold is I will be closer to 2,500 by the end of the year. I also think, you can loop in gold and WTI and fixed income into a bucket that really is a flight to safety trade, given all the geopolitical risk that we're seeing right now. I know there's a lot, for example, going in Rafah, and I've had a lot of conversations with clients about how to manage this geopolitical risk in portfolio. So yes, I still think gold could be attractive. Maybe the big wins have already been had, but I think you loop that into a few other safety trades, and that could propose a really nice hedge to some of the stuff we're seeing in the world.